Hi everyone, welcome back to my channel. This is my usual weekly technical analysis outlook videos in which I will comment on what I think will happen to some FX crosses and equities. I have another series running, the financial market series, that breaks down topics in the financial market in ways that are easy to understand. You can find the links in the description about these videos. As always, before I begin, I want to clarify that this is not a solicitation or recommendation to enter into long or short positions in the names that I will mention in this video, nor do I have existing positions in them. This is not financial advice, and if you're using this content as a guide to trade, you are doing so at your own risk. Alright, let's start. The first part of this video will be reviews of the names I covered in past videos. This week will be on sterling dollar, Kiwi dollar, gold, dollar stocky, Swiss yen, Aussie Swiss, BMW, Verizon, and Adobe. The new coverages are on the US 10-year yield, dollar yen, dollar real, and dollar peso. In case you don't want to know the old stories and just want to know what is new, I have put in timestamps in the description for your convenience. As noted in the video on the 25th of August, I expected sterling dollar to correct lower first before resuming the upside, because corrections are common after a rally. So there were two rallies over here and here. Therefore, I expected a correction first. Sterling dollar has had 2 weeks of correction, and sterling dollar reached a low of around 1.3002 before bouncing higher over here. The outlook remains bullish for sterling due to the symmetrical triangle, but I will not rule out further correction in upcoming weeks. At least, I will not decide that the correction is over until there is another week of advance. I noted that I believe Kiwi dollar was rejected by the resistance at 0.6278 in a video on the 2nd of September, and therefore I expected Kiwi dollar to correct lower first. This is also in accordance with the theory that after pattern completions, there usually are corrections first before resuming the downside. Now, given the absence of firm support and given that Kiwi dollar has closed below the 20-day simple moving average and the latest price action getting rejected by the 20-day simple moving average, I still think there could be further downside as a form of correction in Kiwi dollar in the upcoming days. So this correction could extend to the cloud support currently around 0.6040 before bouncing higher going forward. But the overall trend in the Kiwi dollar remains bullish, given that it has completed two bullish patterns, one on the daily chart that you're looking at right now. It's a double bottom. On the weekly chart, I'm not showing over here, it's a completion of a symmetrical triangle. I will continue to target a move to 0.6370 first. In the last video on the 8th of September, I cautioned against positioning for further upside in gold until there is bearish confirmation or invalidation. So we have an invalidation of this potential bearish pattern this week via a breakout above the wedge resistance over here. So this bearish pattern is no longer valid. We should now switch back to a bullish outlook on gold, which was the original outlook, and the target is at 2600. Now, when I first covered gold, that was back in June, I noted that the textbook target back then, due to a rectangle pattern, was at 2582.97, somewhere around here. So gold on the 13th of September has reached this textbook target. So I will now cease coverage on gold until there is new development. I last reviewed dollar stocky in a video on the 18th of August and said that there is bearish confirmation over here via a breakdown below the symmetrical triangle. The bearish outlook was well expected as dollar stocky subsequently tumbled over here the following week and corrected shortly 2 weeks later before resuming the downside this week. And this week, dollar stocky formed an upside exhaustion candlestick. So in addition to this bearish pattern on the weekly chart, dollar stocky may also be forming a bearish pattern on the daily chart. Let me switch to a daily chart view. I believe dollar stocky may be forming a head and shoulders top on the daily chart, and it looks like this. So the decline in dollar stocky in the last 2 days, which closed below the 20-day simple moving average, has given dollar stocky a downside bias, forming the second shoulder, and the neckline is around 10.10. A daily close below this will complete this bearish pattern, which coincidentally has the same textbook target as the symmetrical triangle at 9.21. In the video on the 8th of September, I noted the formation of a head and shoulders top in Swiss yen. This week, Swiss yen completed this bearish pattern and the textbook target is at 153.66. And note over here that the close within the Ichimoku cloud is also a negative sign, suggesting increased risk of a close below the cloud going forward, which also means a bearish direction. Watch out for potential bounces around the supports at 160 as well as 162.2. In the video on the 25th of August, I believe I have erroneously judged that the second shoulder has been formed over here. Turns out, I believe the new second shoulder should actually be here, and this last 3 days closed within the cloud is a positive development. It suggests a potential break above the cloud, which will give Aussie Swiss a bullish tilt. In any case, I'm still thinking that the Aussie Swiss is forming a head and shoulders bottom, a bullish pattern, and I'm waiting for a close above the neckline at 0.5814 for bullish confirmation. Once it's done, the textbook target is at 0.6258, and note the resistances at 0.5872, 0.6 the psychological resistance, as well as 0.6085 to be resistances that can reject the Aussie Swiss lower when tested. I just touched on BMW in the previous video, saying that last week's decline over here is highly likely the bearish resumption phase. I noted in that video that the support at 68.57 may prevent BMW from reaching its textbook target. So this week, BMW tumbled to the low of 68.60 before bouncing higher and forming a downside exhaustion candle. I don't think this bearish trend is over, but this bounce could first trigger a move higher for the BMW and tilt BMW into a correction phase again towards the neckline, maybe slightly higher before resuming the downside. The textbook target for BMW is still at 61.48. It has been a while since I updated on Verizon Communications in the video on the 7th of July, but finally there is now bullish confirmation. Verizon Communications broke above the neckline at 42.58 this week and completed its head and shoulders bottom, a bullish pattern. The textbook target is at 55.08, and note that there are resistances at 46.21 and the range of 50 to 51.9, all of which can reject Verizon Communications lower when tested. There is a hiccup in Adobe this week. I last noted its bullish potential in the video on the 25th of August, stating that it is nearing completion of a head and shoulders bottom. Adobe completed this bullish pattern on the 12th of September, but price action slumped on the 13th of September. So there are 3 reasons why I still think Adobe is bullish, having completed this bullish pattern. I still think the next move for Adobe will be higher. 3 reasons. Number 1, because of this gap down on the 13th of September. I've always said gap downs are often filled, so that's why I expect this gap to be filled, hence a higher move for Adobe. Number 2, you can see that price action is excessively below the lower Bollinger, which this usually introduces a 1 to 3 days worth of a rebound. Number 3, you can see that price action fell into the cloud, but then rebounded to close slightly back above the cloud. A bullish bias still prevails in Adobe, and I would say that Adobe is at least supported. So these are the three reasons why I think Adobe will be headed higher going forward. The textbook target resulting from this head and shoulders bottom is at 727.92, three resistances at 634.92, 674.10, and the psychological resistance at the 700, all of which can reject Adobe lower when tested. Okay, we're done with the reviews. I want to start off the new coverage with the US 10-year yield, the US government bond 10-year yield, because this plays a crucial role in determining the outlook of a lot of FX crosses, especially the dollar and the yen crosses, as well as the stock market. Now, even if the US Federal Reserve is expected to cut interest rate and the market expects a 50 basis points cut next week, the chart is suggesting that the 10-year yield may be preparing for a bullish breakout. Here, I suspect that the 10-year yield is forming a falling wedge, a bullish pattern, and the RSI is showing price momentum divergence, also a sign of a rebound. If the 10-year yield breaks above the resistance trend line, I believe it will enter into a bullish trend and there is potential for a move to 4.3%. Alternatively, a breakdown below the support trend line will invalidate this bullish pattern and the 10-year yield is expected to resume its bearish trend. The reason I highlighted the US 10-year yield first is because dollar yen, with which the 10-year yield is closely correlated, is also showing bullish potential with the same signs. Dollar yen is also forming a falling wedge bullish pattern, and the RSI is also showing price momentum divergence. So if there is a breakout of the resistance trend line, dollar yen is expected to enter into a bullish trend with potential to advance to 152. Of course, a breakdown below the support trend line will invalidate this bullish pattern and dollar yen is expected to resume its bearish trend. The next two FX crosses are a little bit more exotic. I'll start off with the dollar real. I believe it is forming a head and shoulders top, a bearish pattern. The second shoulder may have just been formed this week, and note that dollar real's attempt over here to break above the Ichimoku cloud ended in failure in the last two trading days, resulting in a rejection to close below the 20-day simple moving average. A close below the neckline at 5.3780 will complete this bearish pattern that has a textbook target at 4.8950. There are supports at 5.2460 as well as 5.0675 that can bounce dollar real higher when tested. The last one for this video is on dollar peso. It appears that dollar peso has just completed a rising wedge, a bearish pattern via a breakdown below the support trend line. The textbook target of this bearish pattern is at 17.55. There are some supports, firstly at the cloud over here, and then we have supports at 18.9 as well as 18.59, both of which can bounce dollar peso higher when tested. That's the end of my sharing. I will give updates to these crosses and names only when there are meaningful development, and in the next video it will highly likely be on new crosses and new names. If you like what I'm doing, please help me out by giving me a like, please subscribe and hit the notification button for more videos like this.